Good evening, everyone. Welcome back to our online live sharing class. It is great to see everyone's enthusiasm and active participation in the stock investment. Now, today, we will continue to dive into various aspects of stock investments and help everyone better understand the market and master effective investment strategies. In our last session, besides analyzing the current market situation, we also studied the investment philosophy and literacy of one of the world's top 5 greatest securities trader, Bernard Baruch. Now, we hope this has been helpful. Now, of course, improving trading skills is not something that happens overnight. It's going to require consistent effort over a long period of time, just like achieving profitability. Now, you cannot realize your wealth dreams with just 1 or 2 trades. Now, I hope everyone will gain something from today's session and continue to progress in their investment journey. Investing is an art that requires time and patience. So let's strive together so that everyone can gradually achieve their investment goals. So let's begin today's lesson. Okay, so kicking off with today's contents. Of course, we always go over some important financial news and some major headlines that cannot be missed. We will also be tracking and analyzing the domestic market indices, which is also essential daily. Everyone can try their own analysis after the market closes each day. This is part of taking the first step on your own, and you do not need to be relying solely on just my analysis, and persistent daily will definitely improve your analytical skills over time. Now, as I've mentioned before, in any industry, achieving success requires long-term dedication, effort, and relentless perseverance, which should be crystal clear to everyone at this point. Now, besides these updates, we are also going to be talking about a little bit of our asset management scale and how we achieved rapid asset growth during this period. We are also going to introduce another investment master, since you guys all enjoy these legends and masters from the past. So his name is Richard J. Dennis. Apart from being known as the Prince of Speculation and having achieved tremendous profits, he has brought different perspectives to the financial trading world and even opened up new horizons. Now, a lot of you are wondering, what is that exactly? We're going to get to that a little bit later. So, without further delay, let's continue to go over our macroeconomics news. All right, so tonight we're going to be sharing a little bit about the analysis of some major news. As we all know, for India, it has now entered the post-election era, and the impact of elections on the market is becoming weaker. The market will gradually return to normal fundamentals and technical analysis. So next, we're going to continue to focus on domestic and international economic data, as well as the economic development. All right, so let's jump into our first piece of news. Fitch Ratings raises India's 2024 to 2025 GDP forecast to 7.2%. So last time we talked about it, it was around 6.8. Now the forecast has been upped to 7.2%. So let's take a look at the data regarding the Indian economy. Fitch Ratings has raised its GDP forecast for India for 2024 to 2025 to 7.2%. What does this actually mean, right? So according to Fitch Ratings quarterly global economic outlook, which is the GEO report released on Tuesday, India's economy is expected to grow at 7.2% this fiscal year, so stronger than earlier expectations. It is anticipated that the Reserve Bank of India will cut interest rates by only 25 basis points during this period. Now, due to increased confidence in the recovery prospect in Europe, the revival of China's export sector, and strong domestic demand momentum in emerging markets outside of China, the rating agency has also revised upward its 2024 global economic growth forecast from 2.4% to 2.6%. So Fitch also wrote, we still expect the Reserve Bank of India to cut policy rates this year, but only once to 6.25%. Now, that's a lot better than no rate cuts. So we've been sitting at 6.5%. Now we're expected to go down only once, down to 6.25% for 25 basis points. Now, in March Global Economic Outlook report, we expected a 50 basis points cut this year. So we anticipate cuts of 25 basis points each in 2025 and 2026. India's growth forecast has been revised up by 0.2 percentage points from March forecast. Now, regarding India, Fitch has noted investment will continue to grow, albeit at a slower pace than in recent quarters, while consumer spending will also recover with strengthened consumer confidence. However, the agency expects economic growth to slow down in the coming years and approach its medium-term trend forecast. Fitch expects that by the end of this year, overall inflation in the South Asian country will continue to decline to 4.5%, with average inflation rates reaching 4.3% in 2025 and 2026, slightly above the midpoint of the Reserve Bank of India's target range of 2 to 6%. Now, whether from the perspective of India's domestic economic development or the forecasts of internationally renowned rating agencies, it is evident that India's economy is gaining strong momentum, which is precisely the foundation for the long-term bullish trend in the Indian stock market. However, in the short term, valuations in the Indian stock market remain high. Only after adjustments occur can some stocks demonstrate their own investment value. This is why we have consistently emphasized one of the key reasons not to engage in ordinary stock trading for the time being. Lots of information to absorb there. So lots of growth. All the rating agencies are seeing this strong momentum in India's growth. Okay, second piece of news. India's Prime Minister Modi's government to stick to deficit target despite poll setback, says a source. So let's take a look at the content related to the monetary policy of the Reserve Bank of India. So Shaktikanta Das, governor of RBI, said on Tuesday that despite increasing calls to adjust monetary policy, India should avoid adventurism and continue to focus on reducing the inflation rate to 4%. As I've said earlier, a lot of the predictions are 4.3% in the South Asian countries. We're trying to keep it reduced down below 4%. Currently, there are calls, again, to change stance, but we would like to see clear evidence that inflation should slow down, or perhaps even pick up slightly. It's too early to talk about changing stance now, so this is what Das said at the ET Now Leadership Dialogues event. Earlier this month, the central bank held its policy meeting for the 8th consecutive time, keeping the key repurchase rate unchanged at 6.5%, and stated that strong economic growth would provide room for it to focus on bringing inflation down to the medium-term target. Now, Das stated in his speech at the event that the economic activity in this South Asian country continued to show strong momentum in the first quarter of the fiscal year. Starting in April, the private investment also accelerating. Now, he have said we have no reason to be complacent, but the convergence of various factors at present is highly favorable for India's growth and stability. As of March last fiscal year, India's economic growth far exceeded expectations, reaching 8.2%, and the RBI expects the economy to grow 7.2% this fiscal year. So in fact, this aligns with the forecast results of the credit rating agencies as we discussed earlier. At the same time, Das noted that despite global economic growth not yet picking up, external demand is expected to remain strong, providing significant support for India's goods and services exports. Regarding inflation, Dash mentioned that the prices are easing, but very slowly, and reiterated that last mile of disinflation is difficult and very slow. So he added that the core inflation reached a historical low around 3% in May. Now, everyone here, members and friends, what more important information and content can we derive from this news? So, first, we look at the RBI is not going to cut interest rates quickly. So, expectations of a rate cut in India to significantly boost the stock market, we can put that aside for now. And even if we were going to get a rate cut, it's going to be 25 basis points. So, secondly, balancing both lower inflation and maintaining economic growth is often challenging. It's difficult to achieve both at the same time. So, we are growing, so we're going to have to stall on the inflation. Now, in theory, a potentially huge positive impact, at least in the short term, cannot be realized. So instead, this presents a disadvantage factor for the market. Last piece of news. Fed officials steer cautiously as they await data confirming inflation slowdown. So let's pay attention again to the information about the Fed's interest rate cuts. So Fed officials, encouraged by recent data, are hoping for more evidence to prove that inflation is continuing to cool and that the labor market remains strong, so that they can cautiously consider policy easing measures later this year. Now, John Williams, president of the New York Fed, said in an interview with the Fox Business Channel on Tuesday, "I expect interest rates to gradually decline in the coming years, reflecting inflation returning to the 2% target level and the economy heading towards a very strong and sustainable path of development." But he refused to disclose when the rate cut would occur. The financial market is currently expecting the first rate cut in September. Now, I won't make specific predictions about the direction of the policy, he said, adding that the specific direction depends on how the data evolves, and also mentioned, "I think things are moving in the right direction, and ultimately will implement loose policies." For Richmond Fed President Thomas Barkin, the key is to continue to ease the pressure on prices for services and goods. Barkin said in a live interview with MNI Network, "We are clearly behind in terms of inflation. We also said that the recent data showed that consumer prices did not rise at all from April to May, which is encouraging." However, he noted that data has been very volatile since last year, which means the future policy path is not clear. This is the first public statement by the two since Fed's policy meeting last week, when the Fed kept its benchmark interest rate at the range of 5.25% to 5.50%. The Fed also released its latest economic forecast, showing that its officials have reduced their expectations of rate cuts this year from 3 times in March to now once. As inflation data for the first few months of 2024 has been stronger than expected. Most analysts believe that the reduction in the number of rate cuts means a later start for the rate cuts, especially after Fed Chairman Jerome Powell said that the first rate cut would have a significant impact, as it could reshape market expectations. Neither the Reserve Bank of India nor the Fed currently has plans to cut interest rates. So, in general, whether internationally or domestically in India, it is unlikely that the stock market will benefit from monetary policy in this short term. Okay, so that is going to wrap up our news for the day. So, back to what we were originally saying. Don't expect the rate cuts until later in the fall, September, maybe November. So for now, we just focus what's in front of us. Okay, market recap time. So let's take a look at the performance of the domestic stock market in India today. The Indian benchmark stock indices, the Nifty 50 and the Sensex, have been jumping up for 7 consecutive trading days now. But the overall increase in these few trading days is not that significant. It can be seen that although the indices have been in volatile upward trend in the short term, the overall market sentiment is not considered very good. At present, we are at a critical moment in the comparison of our asset management scale. So regardless of how the market fluctuates, it has no impact on our final profit results because the trades we are currently participating in are mostly certain profitable trades. The reason I still insist on analyzing the market situation for everyone is simply to hope that everyone can learn some trading techniques when we are making money. In the current market rhythm, for many individual investors, the index chart of stock market may look good, but when you actually trade, you will find that making money is not that easy, and there is possibility of loss if you're not careful. Also, keep in mind, emotions get involved, right? Now, of course, now happens to be an important period for our wealth growth plan. If it were not during our wealth growth plan, could everyone avoid encountering such a market situation? Now, regarding this, we'll talk more about it with everyone at a later time. For the rest of today, we're going to specifically look at the trend for the Nifty 50 index and the Sensex index separately. Okay, so first, let's take a look at the Nifty 50 index. Today, after the overall rise and the gap opening of the Indian stock market, the Nifty 50 index has consecutively opened with a gap up for 7 trading days. However, now despite this, the Nifty index has not accumulated a substantial increase in the past few trading days. So from the technical chart perspective, the trend of the Nifty index today is somewhat different from the past. In the past, even if there was a drop after the opening gap ups, either the price would rise before the close or it was because the gap up range was too large. Even if the intraday trend was downward, it would eventually close higher. What's different today is that after the gap up opening, there was a downward adjustment and the intraday fluctuations were very intense. But the index eventually closed lower. Now, this is the first time in the past few trading days. Looking at the trading volume in conjunction with the price, there has also been a change. During the earlier oscillating upward trend, the trading volume gradually decreased, as I put it in the blue boxes at the bottom. Now, however, that the daily level has started to change from a rise to a fall. Although the decline today is not significant, the trading volume has gradually started to increase. Now, this phenomenon is not good news for the bulls. In the next 2 to 3 trading days, it is very likely to see further downward adjustment. The Nifty 50 index is overvalued, which will also affect the enthusiasm of buyers in the market. We expect the market is likely to undergo a turnaround in the short term. So regardless of how the market is evolving, in times of greater uncertainty, it is best to steer clear of it. Now, we can focus on making profitable trades with 100% certainty other ways. All right, so that's a little bit of the chart. You can see these big red candles. Then you can see it rebounding back with these big green candles. Volume decrease at the bottom. So this is kind of what it looks like on the Nifty 50 on a day-to-day chart. All right, so moving into our Sensex chart. Today, the index also opened with a bullish gap, marking the 7th consecutive trading day of such an opening. However, at the close, the Sensex index was indeed stronger than the Nifty index as it closed higher. So, from the technical perspective, since the index broke through the upper trend line of the upper channel on the 7th of this month, the price has been consistently trending above this line. Now, this indicates a relatively strong trend. So if the price continues to rise, it might trigger a rapid downward adjustment instead. Whether it's the Sensex index or the Nifty index, they both experienced accelerated declines in the last half hour of trading today. Additionally, it's evident that the trading volume in the last half hour was relatively large. What does this actually indicate? It shows that whenever the market surges, profit-taking selling pressure emerges. So clearly, these funds are employing a sell high, buy low strategy quite thoroughly. In the near term, there are no major fundamental news to be announced in the market, so it's currently difficult for external factors to significantly impact the market. So in the short term, the index is likely to be dominated by technical trends. The profitability in the current market remains poor. For instance, today the numbers of declining stocks far exceeded the number of advancing stocks. In such a situation, can one be sure of making money when trading ordinary stocks? The answer, I believe, is quite obvious. So for individual investors at present, risk control will have to take precedence. All right, so that's going to sum up our analysis of the Nifty 50 index and the Sensex indexes. I hope this was helpful to everyone. So next, we're going to share the next parts of our content for today. Okay, so Asia Pacific headquarters location selection. Okay, so currently we are in the second phase of selecting the Asia Pacific headquarters location, which is the stage of competing in asset management scale. We are now at a crucial moment. At the same time, our 5x profit plan is officially open to all members and friends. So only through a short-term profits can we achieve an explosive growth in everyone's capital, while also laying the foundation for explosive growth in asset management scale in our India region. Personally, and as a team, we are very confident about this. So I believe that since following our wealth growth plan, everyone should have already reaped in considerable profits. Starting tomorrow, we will officially launch the 5x plan. This is an internal fund jointly launched with other institutions, specifically internal financing among institutions that is not publicly disclosed. That's very important in the secondary market. Now, currently, we have conducted about a week of support buying to stabilize the situation. It is now very stable, and we expect a daily increase of no less than 10% in the future. Therefore, with compounding and leveraging margin, we will achieve our 5x return very quickly. Thus, we also believe that the asset management scale in India will experience explosive growth, thereby securing the first place in this competition and ultimately ensuring that the Asia Pacific headquarters is going to be located here in India. In any case, the most important thing is to do what needs to be done now. Regardless of the results of our asset management scale competition, at least all members can indeed harvest high profits. We are trying to achieve a true win-win corporation. So due to time constraints, I'm not going to elaborate any further. Please follow the trading prompts for your transactions. Of course, for members who haven't made appointments yet, you can now consult with my assistant to book the 5x profit plan. Now, one of the main questions we ask is, can successful trading be taught? So in the last class, we learned about the investment philosophy and the investment literacy of one of the world's 5 greatest securities trader, Bernard Baruch. So, before learning from today's master, let's first ask everyone a very simple question. Can successful trading be taught? In other words, can success be replicated? Here, I'm specifically referring to financial trading. Now, there has always been controversy in the market about this question. The proponent's point of view is that some trading strategies are systematic and standardized. As long as these rules are strictly followed, success is possible. Therefore, these strategies can be taught and learned. Now, at the same time, many technical tools and algorithms used in modern day trading are standardized as well, and traders can improve their trading effectiveness by learning to use these tools. Now, the opposing view is that trading is not just a matter of technique and knowledge. The trader's psychological qualities, emotional management, and decision-making abilities are also crucial. And these psychological factors are difficult to teach and must be cultivated gradually through actual trading. Now, at the same time, financial markets are inherently highly uncertain and volatile. And historically, successful strategies may no longer be effective in the future. So even successful traders cannot guarantee that their strategies will remain effective in the future. So what is the answer? It wasn't until the appearance of Richard J. Dennis that an accurate answer was provided for this matter. Before discussing this answer, let's take a look at who Richard J. Dennis really is. Okay, Prince of Speculation, Richard J. Dennis. Now, before we introduce Jim Rogers, also a renowned investment guru, we learned about his 7 major investment secrets. So I believe a lot of people have gained a lot of experience and ideas. Now, in the field of professional trading, only a few people leave indelible mark on the industry and become true legendary figures. Now, one undoubtedly is Richard J. Dennis, legendary trader, trading promoter you may not have heard of. So I want to dive into this and give you a little bit of background on who this guy really is, right? Richard Dennis was born in 1949 in Chicago. Possessing all conditions for success in the trading field, he was fascinated by numbers and patterns from a very young age. Richard began his career very early, experimenting with commodity futures in his teens. Through careful study of the market behavior and trying different trading techniques, he gradually honed his skills. Now, despite encountering setbacks along the way, his perseverance and thirst for knowledge drove him forward. Richard achieved unprecedented success in his career. In the 1970s, he started trading with a loan of $1,600, and reportedly within just 6 years, he turned that amount into $350 million. Although such trading success is rare, Dennis's strategies and best practices might inspire everyone here to pursue their own path in trading. Okay, so a little bit of background, a little bit of an autobiography on Richard J. Dennis. So, as we just said, he turned $1,600 into a $350 million profit in about 6 years. Now, when the futures trading fund he managed suffered significant losses in 1987 stock market crash, he withdrew from the trading industry for several years. He has been actively involved in political activities of the Democratic and Libertarian parties, most notably in the movement against drug prohibition. At the age of 17, Dennis became an order runner at the Chicago Mercantile Exchange trading floor. And then several years later, he began trading with his own account at the Mid-America Commodity Exchange, an entry-level trading floor for trading mini contracts. Now, the circumvent that requires the traders to be at least 21 years old, He acted on his own orders runner and employed his father to trade on the floor for him. Richard obtained a bachelor's degree in philosophy from DePaul University and then received a graduate scholarship in philosophy from Duquesne University, but later changed his mind and returned to the trading field. He borrowed $1,600 from his family, and after spending $1,200 to buy a seat at the Mid-America Commodity Exchange, he had $400 left as trading capital. By 1970, his trading has increased this capital to $3,000, which he called real money compared to the $400. By 1973, his capital exceeded $100,000, and then in 1974, he made a profit of $500,000 by trading soybeans. And by the end of that year, he became a millionaire at the age of 26. Now, Richard repeatedly set weekly and monthly highs in the inflationary trend markets of the 1970s. So profiting from them, at the time, there were repeated crop failures, and in 1972, the Russian wheat deal took place, during which Soviet agents secretly purchased 30% of American wheat in just a few weeks. Now, this laid the foundation for the subsequent years of price stability and sustained trends. During this period, anyone using simple trend tracking methods and a dartboard could make $1 million. Now, unlike most floor traders, Richard held positions for longer periods, weathering short-term fluctuations and holding positions in the medium term. Richard often used a pyramid buying approach. In the late 1970s, he purchased a formal membership at the higher price Chicago Mercantile Exchange and set up an office upstairs to trade in more markets. Now, back to, can trading be actually taught? Dennis believed that successful trading could indeed be taught. Now, to settle a debate with his friend and fellow trader William Eckhart on this issue, Dennis recruited and trained 21 men and 2 women. He divided them into 2 groups, one starting in December 1983 and the other in December 1984. He provided just 2 weeks of training to these individuals known as turtles. Now, that's going to be an important part, so remember turtles. Teaching them a simple trend following system. The turtles were instructed to trade a variety of commodities, currencies, and bond markets. They were to buy when prices rose above recent levels and sell when prices fell below recent levels. During losing periods, they were taught to reduce their positions, and they actively pyramid investments, increasing the exposure by up to 1/3 or half, though never increasing total capital by more than 24% at any given time. Now, this trading system resulted in losses during market range bound periods, so typically lasting several months, and profits during significant market swings. In January 1984, after the 2-week training period, Dennis allocated a trading account to each turtle to apply the learned system. During this trial month, they were allowed to trade up to 12 contracts per market. At the end of the trial, those who successfully traded the system were given accounts ranging from $250,000 to $2 million to manage their own funds. 5 years later, when his experiment concluded, it was reported that Dennis's turtles collectively earned $175 million. Subsequently, the trading method they used became known as the turtle trading method. So to this day, many continue to use it with considerable success, demonstrating that indeed successful trading can be taught. Among the turtles trained by Dennis, many went on to become successful commodity trading managers, employing methods similar to the turtle system, but not identical. Okay, so since we're talking about turtle trading method, let's briefly introduce it for today. So for those who want to study it more in detail, there are lots of relevant books and videos for self-learning. One of them is called The Complete Turtle Trader. There is tons of things you can do after class to enhance your own knowledge, right? So the turtle trading method is a systematic and rule-based trading strategy that emphasizes trend following and risk management. You're going to keep hearing that, risk management. Although the market conditions are constantly changing, its core ideas and methods still hold significant lessons for modern traders. The first step in applying the turtle trading method is to choose a market. Traders need to determine the market they want to trade in, such as commodities, futures, stock, indices, forex, etc. It's evident that the turtle trading method can be applied across multiple markets, not limited to a specific one. So, second step, one must identify the breakout period. Now, this essentially refers to what we commonly call the concept of time periods. So, for example, choosing a time period for the breakout, such as 20 days, 55 days, whichever serves as a basis for entry signals. Number 3, we got to calculate position sizes based on market volatility and account capital for each trade. Now, that's a very important one that I don't think we've kind of gone over with any of the other masters. Position sizing, right? So, fourth, execute trades. When prices break above or below established highs or lows, execute buy and sell operations. Number 5, you got to set stop losses. Set reasonable stop loss points for each trade to ensure manageable risks. Now, that is a very important point, as you're going to keep hearing it over and over again with a lot of the masters. Stop losses, risk management. That is one of the most crucial points for any trader. We must manage risks, okay? Number 6, last one, we got to track trends. Continuously monitor market trends and adjust positions or close positions when they're necessary. These are the specific steps when applying the turtle trading method. So, as mentioned earlier, if you're interested in the turtle trading, you can further deepen your own studies and research. All right. So, turtle trading strategy. So, Richard Dennis's strategy combines technical and fundamental analysis with rigorous risk management. He believes in systematic trading methods, so relying on predefined rules and guidelines rather than making impulsive decisions based on emotions or subjective judgments. His strategy primarily focuses on trend following, so the goal is to identify and follow major market trends, whether they relate to currencies, commodities, or other financial instruments. He believes trends have the potential to bring substantial profits and aims to maintain positions in these trends for as long as possible. Thus, his approach can be described as similar to position and volatility strategies. When determining the timing of trades, Richard Dennis employs a combination of technical and fundamental analysis. He analyzes price charts to identify key support and resistance levels and uses various technical indicators to assess market trends and their timing. Now, this technical analysis helps him identify potential entry points and confirms the validity of trends. In addition to technical analysis, Richard incorporates fundamental analysis into his trading decisions. He studies macroeconomic factors, which we always do every day, market fundamentals, and events that could impact the market. Dennis's trading strategy also places significant emphasis on strict risk management. He understands the importance of capital protection and limiting losses. This sounds very familiar, right? We're using macroeconomic factors, we're looking at market fundamentals, and we're looking at all exterior things that can impact our market. That is what we do on the regular basis. A key element of Dennis's trading strategy is position sizing. He allocates a certain proportion of trading capital to each trade based on the level of risk associated with each trade. The specific proportion depends on market conditions and his assessment of the trade potential. Richard Dennis employs a concept known as volatility-based position sizing. He uses the ATR, which is the average true range, a market volatility indicator, to determine the position sizes. Now, ATR provides an estimate of the average price range over a certain period of time, enabling him to adjust position sizes based on market volatility. During periods of high volatility, he reduces position sizes to manage risks, while during periods of low volatility, he increases position sizes to capitalize on the potential larger movements. So that is his strategy. All right, so turtle trading principles. 4 major ones. The turtle trading system is a trend following system. It's going to emphasize on position sizing, entry and exit rules, and last, risk management, right? The system is based on a specific set of rules and principles aimed at identifying and tracking long-term market trends to profit from them. The system aims to capture major trends in the market while minimizing losses to the greatest extent possible. In simpler terms, it means that when we take profits, we aim for the most amount of gains, but if losses occur, we restrict them to a minimal amount. So just think about it. How could it not be profitable in the long run if we always tend to gain maximum and we lose minimum, right? Now, the system emphasizes risk management, position sizing, and the specific entry and exit rules aimed at identifying and tracking long-term market trends. While the system has several advantages, including its potential for high returns and an emphasis on the risk management, it also has some potential drawbacks, such as requiring discipline and patience, and the possibility of missing out on short-term trading opportunities. Overall, for traders who can effectively follow its rules and principles, the turtle trading system is a powerful trading strategy. So next, let's specifically analyze the detailed content of these 4 principles. So number 1, trend following. The turtle trading system aims to identify and track long-term market trends. The system uses various technical indicators to recognize trends and determine entry and exit points. Turtles employ a range of technical indicators, including moving averages, to identify trends and decide when to enter or exit trades. However, it's not limited to just moving averages. So let's look at some charts to see practical examples of trend tracking. The graph you see here is a daily chart of a certain stock. Of course, a specific stock isn't important. What matters is the method. Now, in this example, a simple trend following strategy involves buying when the closing price of a candlestick is above the 50-day moving average, as seen on the far left. So our purchase point right here. Subsequently, trend followers would hold that position until the weekly close falls below the same 50-day moving average, which is our middle arrow. Now, there are countless ways to address challenges and develop your trend tracking system. For instance, you can use monthly charts, you can use daily charts, whatever you're comfortable with, right? So you can employ short-term moving averages for high-frequency trading. The most crucial aspect is finding the method that best suits you personally. It's going to fit your lifestyle, has to fit how you invest, and also all of your trading goals. So one thing to note here is going to be consistency. Now, what does consistency actually mean? It just means that if you buy within a daily time frame, you should also sell within that daily time frame. Another point that I want to make is the smaller time frames exhibit a little bit more noise and distraction in their patterns, whereas larger time frames show less distractions and noise. Okay, number 2, position adjustments. So position sizing, position adjustment, same thing. The turtles used a position sizing method called the 1% risk rule. Now, the rule dictates that traders should not risk more than 1% of their account balance at any single trade. That means if a trader's account has a balance of $100,000, they should not risk more than $1,000 on any single trade. Now, of course, I personally don't think the 1% rule fits me. Is not going to be a fixed standard for everyone either. Traders can optimize parameters based on the size of their account, funds, and the characteristics of the traded instruments. However, it is not advisable to adjust this data way too much. As I understand it, position sizing adjustment refers to maintaining positions in line with trends in the account, letting profitable positions run while cutting losses early on unfavorable positions, which have either been stopped out or adjusted out of the account. This is also one of the important guarantees that allows us to cut losses short and let the profits run when trading. So when we have position sizing, one of the major thing is risk control, right? So if you have a risk in mind that you're going to do, set the stop loss. That is the easiest way. It will automatically trigger when it hits that point. It will reduce your losses. Okay, third principle, entry and exit rules. So the turtle trading system uses a specific set of entry and exit rules to determine when to enter and exit trades. The system aims to capture major trends while minimizing losses during market fluctuations. Turtles use various entry and exit rules depending on the market conditions and the specific financial instrument being traded. So generally, turtles enter trades when the market breaks out of range, then uses trailing stop orders to lock in profits and limit their losses. We've already discussed entry rules earlier, such as buying when the closing price is above the 50 MA line. So next, let's talk about the exit rules. So common exit rules including selling once the trade falls below the low of the signal bar. So when the signal bar is close at the low, we should sell. The signal bar is simply the bar where the closing price is below the moving average line, as in our example above. So the blue is our moving average line, for those that don't know. So another exit rule is setting stop loss below the pivot point on the chart. A pivot point is a price level where if a stock trades below it, it indicates the market has lost price support. Losing support increases likelihood of further price declines. Set a stop loss there, peg it, right? So let's use the stock example from the above. I have marked 2 exit points. So you're going to see over here, exit 1, exit 2. A few points to note. Exit point number 1 allows traders to hold a larger position because the stop loss, so the exit point, is very close to the entry point. However, the trade-off is higher likelihood of stop loss and exiting with just a minor loss. Exit point number 2 is further from the entry point and nominal position size is smaller. However, the trade-off is lower profitability of being stopped out due to random noises. Okay? So take some screenshots. Okay, risk management. The fourth rule. The turtle trading system emphasizes risk management, controlling losses, and capital preservation. That is very important. You want to maintain as much capital as possible. The system uses stop loss orders to limit potential losses in trades. Now, this means that if a trade turns unfavorable for the trader, they will automatically exit the trade at a specific price to restrict potential losses. Risk management is the core of the turtle trading method and indeed all successful trading strategies. By strictly controlling the risk of each trade, setting reasonable position sizes and stop loss levels, diversifying investments, and maintaining a good trading mindset, traders can effectively reduce trading risks and increase the probability of long-term profitability. Now, the risk management mainly consists of these 4 points. Risk control. Strictly control the risk of each trade, not exceeding the predetermined risk limit, right? So you need risk control. Everybody has different risk appetite. You must understand yours. Number 2, discipline. Strictly adhere to the trading plan and risk management strategy. Unaffected by emotions. Maintaining discipline is key to long-term success. Now, discipline is one of those things that nobody can really teach you. Whether you want to wake up every morning and make your bed, that is going to be on you. No matter how many times people tell you, it's something that you must practice over and over and over and over again. Number 3, diversification. Do not concentrate all funds in one market or asset class. Reduce overall risk through diversification. Now, of course, diversification here is not the same as holding too many types of stock, as some new members might misunderstand. So have different streamlines of income, right? So maybe different sectors, different projects, different areas. So if one area is not doing well, all your eggs are not in one basket. Lastly, continuous evaluation and optimization. So regularly assess the effectiveness of trading strategies and risk management measures and optimize them based on market changes and trading experience. Also, many other external factors such as macroeconomics. Great example is we knew the election was coming up. We minimized all our positions in the regular stock market and we just watch the fluctuations, right? So these are your 4 major risk management tips that can help you. And then the 3 major advantages of the turtle trading strategy. So making it one of the more favorite trading strategies for a lot of the traders. Let's look at what these advantages are. So number 1, we got a high profit potential, high profit return, right? The turtle trading system aims to capture major market trends. For traders who can successfully identify and follow these trends, it can lead to substantial profits. Richard Dennis validated this high profit claim with his turtle students theory. According to some statistics, the original turtle traders achieved an average of annual compounded return of 80%. Number 2, emphasize on risk management. The turtle trading system places significant emphasis on risk management. This helps traders avoid catastrophic losses and preserve their trading capital. Number 3, this is applicable to various financial instruments, it applies to a lot of the different sectors as well. The turtle trading system can be applied to various financial instruments, including stocks, commodities, currencies. It's a very versatile trading strategy that can be used across different markets. Now, this aligns perfectly with our global macro strategy. Trend following strategies can be applied universally and can trade any instrument without limitations. If you can plot it on a chart, you can create a trend following system. So that is a breakdown for today on what the turtle trading is. That is going to be it for today. I want everybody to kind of do a little bit more research on the turtle trading because I can't emphasize it enough. It's a great trading strategy. It just requires a lot of discipline and it emphasizes risk control. Once you understand how to control the risks, you can easily profit slowly, and then we can increase the scale. So please go over the content. This is going to wrap up our evening for tonight. I would say memorize it, take some screenshots. Apply this to your daily life trading strategies. This is going to help you in the long term. It's been successful for many people if they put in the hard work. Now, our next online live broadcast is scheduled for next Wednesday, June 26th at 7:30 p.m. I hope to see everybody here again. Thank you very much for all my members and friends for your strong support, and I'll see you all next time.